Welcome to this short video about how managers and entrepreneurs can use accounting information to help them evaluate business projects. Managers and entrepreneurs need to evaluate projects like these. They usually involve significant initial expenditure or investment, and they produce benefits over several years. Now, you can use accounting information to answer two key questions about these. Which of your plans is least risky and which is most rewarding? Let's deal with the risky one first. The basis for this is that the longer it takes you to get your money back, the more exposed you are to risk. So we measure how long it will take to recover the amount invested in the project, and this is called the payback period. So here's an example. We've got two projects. They require an initial expenditure of £100,000, and the cash flows they provide are shown in the table. Now, it should be quite easy to see that it would take 2 years for project A to recover the £100,000 invested. There's 50,000 in year one, there's 50,000 in year two. So this has a payback period of 2 years. After 2 years, project B, however, will only have recovered £70,000, the 25,000 plus the 45,000. By the end of 3 years, there'll be another 60,000, so that's a total of 130,000. So they get the £100,000 back sometime in year 3. So we can say that this has a 3-year payback period. Sometimes people try to narrow it down to the number of months, but we won't be doing that here. So project A has the smaller payback period, 2 years rather than 3, so project A is less risky. Right, moving on to which is most rewarding. Now, it might look easy. Looking at the table, you get £125,000 in total from project A and 130 from project B. But look at year one. Project A generates an extra £25,000, and you can use that £25,000 to bring in more money. So we need an alternative approach. And what we do is we compare any investment with the interest you could get. So we've got a very simple example here of investing £100. If you put it in project X, in 3 years' time, it will pay you back £140. Alternatively, we're assuming you can put it in the bank and get 10% interest. So, in the bank, after 1 year, you've got £110, and then it goes up to £121, and then to £133. Could also show it like this, because 10% is 0.1, so after 1 year, you multiply it by 1.1, and then in the end of year 2, you multiply by 1.1 again, and year 3, you multiply it by 1.1 3 times. So 100 times 1.1 to the power of 3 is £133. So this is less than the £140 from the project. So in this case, that looks like a worthwhile project. But what if we put £105 in the bank? Then that would have a value in year 3 of £140. So the investment in project X has the same value as having £105 in the bank today. If somebody wanted to buy project X, they would probably have to pay £105 for it. So this is a good way of measuring it, because we can use it to compare projects with different timescales. We call this £105 the present value of the future cash flow from project X. So what present value is measuring is the reward for the investment. The process where we reduce the value of the £140 in year 3 to the £105 now, the present value, is called discounting, or discounted cash flow. Right. Most managers and entrepreneurs wouldn't necessarily do these calculations. They would quite happily do the payback, but often the accountants do this. But it can be done. It's not wholly complicated. So, how did I know it was £105? So we've seen that the 140 is 105 times 1.1 cubed. So I simply took the 140 and divided it by 1.1 cubed, and that told me that £105 was the amount that would have to go in the bank to build up to £140. So it's the present value. And if you like formulae, here's the formula to show how that's done. Right, we've just been looking at one cash flow in year 3. What if there are cash flows in multiple years, which there usually are? So what you do is you calculate the present value of each cash flow and you add them up. So here's project A. We're going to assume a 10% discount rate is appropriate. So there are the cash flows, 50, 50, 15 and 10. There's my 1.1, my 1.1 squared and so on. I divide the cash flow by that number, so the 50 becomes 45, then the 15 year 2 becomes 41, the 15 becomes 11, and the 10 becomes 7. And we add them all up and we get a present value for the whole project of £104,000. Now remember, this required an investment of £100,000, so this is £4,000 more than the proposed investment. So the business is worth £4,000 more than it would have been if it only earned the 10% return. So this £4,000 is known as the net present value of the project. Note that receiving the 50,000 in year 2 is worth less than the 50,000 in year 1. It's 41,000 compared with 45,000. So the value of those 50,000s is affected by their timing, by when they happen. And this feature is known as the time value of money. Now the main difficulty with this technique is to establish an appropriate discount rate. For larger companies, the rate will be determined by the accountants, so this is not a problem for managers and other users of accounting information. You should also know that the rate can be adjusted to take account of risk. What about inflation? Now, ideally, the forecast cash flows would take inflation into account. If they don't, then we can adjust the discount rate to take account of inflation. But we won't go into that here. So that about covers all the key points. I hope you found this video useful. Further details can be found in the book by Whitaker. Thank you.